Our final topic from Chapter 7 is the transfer of corporate attributes. In general, corporate attributes don't transfer from one corporation to another. Corporate attributes include such items as loss and credit carryovers, earnings and profits, accounting methods, etc. There's a long list. Think of the things we talked about with the type F, all the various things that would transfer from the New York corporation to the Delaware corporation, the tax ID number, everything. Those are all corporate attributes which generally don't transfer from one corporation to another, but sometimes they can. When the new corporation is an extension of the original corporation's attributes will be transferred. That transfer will occur with the following types of transactions: the type A reorganization, the type C reorganization, the acquisitive D, the F, as we saw, everything transfers there, and the acquisitive G. Also, a liquidation of a controlled subsidiary, which we looked at in a prior chapter, that also is going to entail the transfer of corporate attributes from the controlled subsidiary back up to the parent. Transfer does not occur with these transactions. The type B, well, wait a minute, that's an acquisitive reorganization. Why isn't that one of the transactions where transfer occurs? Because, think of the type B, the shareholders are dealing directly with the acquiring corporation. The target corporation is not technically even involved. The acquirer transfers its stock to the shareholders of the target in exchange for the target's shares. So the target corporation itself is not a party to the transaction. Its attributes, therefore, stay with the subsidiary. They don't transfer up to the parent. A divisive D, also, there's no transfer because you wouldn't know which of the brand new entities to transfer the attributes to. You don't divide them up, so therefore, they don't transfer. Same thing with a divisive G for exactly the same reason. You don't know which of the surviving entities you would transfer the attributes to. So you don't. The type E, no transfer there because there's no change in the corporate identity. It's one corporation at the beginning and the end of the type E reorganization. Also, a partial liquidation. There's no transfer of attributes with a partial liquidation because the surviving corporation is still there. If the attributes transfer, they go to the single corporation that ultimately acquires the original corporation's assets. So there you go. That's why we can't do it with a D, a divisive D, because in a divisive D, there is no one corporation that acquires the original corporation's assets. They get divided up. We have special rules that we want to look at for the transfer of loss carryovers and also earnings and profits. So we're going to spend some time on those two specific types of attributes because of the special rules. First of all, loss carryovers. If you have a net operating loss carryover, the successor corporation will obtain 100% of the NOL of the transferor, even if it does not acquire 100% of the transferor's stock or assets. It will obtain, if it is the successor, 100% of that NOL. The deductibility of the loss will be limited in the year of the transfer as follows. The limit is the successor corporation's taxable income multiplied by the fraction of the tax year remaining. So what they're saying is you can't use the NOL to offset pre-acquisition earnings of the successor. Post-acquisition earnings, yes, but not pre-acquisition earnings. And so they say, well, all right, if there's half a year remaining, then you can use the NOL against half of the earnings, meaning that it's the second half of the earnings when the two have been combined. The first half, when they weren't combined, that cannot be offset with the acquired company's NOL. So here's an example. B Corporation has a net operating loss of $10,000. A Corporation acquires T, so A is the acquirer, T is the target. Acquires T in a Type A merger on October 19th, 2025. A Corporation's taxable income in 2025 is $15,000. Days remaining in 2025 after the merger, well, there's 12 more days in October after October 19th, so the 20th through the 31st is 12 days. And then 30 in November, 31 in December, that's a total of 73 days. I chose the date of October 19th very carefully. You'll see why in a moment. The deduction for 2025 is going to be limited to, well, A Corporation's taxable income for the entire year is $15,000. Multiply that by 73 over 365, which is exactly 20%. And so $3,000. We can use T's net operating loss in 2025 to the extent of $3,000. We cannot use the other $7,000 in 2025. We can use it in 2026 without limitation because A owns T for 100% of 2026. 2025, only 20% of A's earnings can be offset by T's net operating loss. There's also Section 382, which limits the use of a net operating loss following an ownership change, not necessarily from a tax-free reorganization. It could be just a flat-out taxable sale of stock. That could also trigger a 382 limit. What 382 is all about is Congress doesn't like the idea of people just buying net operating losses. They say, no, if you're going to buy the business, that's fine, buy the business. But if there's nothing left of this corporation but its net operating loss, we don't want to have a market for net operating losses. And so they said, we're going to limit what you can take as a net operating loss. First of all, the triggering event is going to be any kind of an ownership change by a 5% or more shareholder, or any tax-free reorganization other than the divisive D or the F. The limit will apply if your triggering event causes a more than 50% ownership change in any 3-year period. So did you go from 0 to 51%? That would be a more than 50% change. And if that happened within a 3-year period, then the event is triggered. Again, whether it's a taxable purchase or a non-taxable reorganization of some sort. Or maybe you went from 45 to 100%. Again, that's a more than 50% change, and so therefore that triggers it. Or you went from 80% down to 20%. That is also a more than 50% change in the other direction. That also counts. And Section 382 is triggered. Now, your annual limit under Section 382 is the value of the loss corporation. What'd you pay for this thing that only has a net operating loss? That times the long-term tax-exempt interest rate. Long-term rates tend to be lower than short-term rates, and tax-exempt rates definitely are lower than taxable interest rates. So the long-term tax-exempt interest rate is about the lowest interest rate that you can have. The limit in the year of the ownership change is that annual limit times the fraction of the tax year remaining. So in the year of the ownership change, you don't even get the full annual limit. You only get the amount for the 20% of the year remaining if you did it on October 19th or whatever the fraction of the year is remaining. 382 limit applies to any net operating loss or capital loss carryover that existed at the time the ownership change occurred. So from now on, when that ownership change occurred, from that point forward, the only amount you can deduct is based on the 382 limit. Once set, it applies each year for as long as the carryovers exist. If a new carryover pops up after the ownership change, that is not affected by 382, but the carryovers that existed at the time of the ownership change, they are affected as long as they exist. If they expire, some carryovers expire, others don't. Capital loss carryovers expire. Net operating losses under current law do not. Well, in that case, the 382 limit will apply for as long as the carryovers exist, however long that is. Let's take a look at problem number 41. Through an acquisitive Type D reorganization, Border Inc. merged into Collie Corporation. So you got Border Collie, get it? Anyway, on September 2nd of the current calendar tax year. Federal long-term tax exempt rate for September is 3%. Border shareholders received 70% of the Collie stock in exchange for all of their Border shares. Border liquidates immediately after the exchange. At the time of the merger, Border was worth $1 million and had a $500,000 NOL. If Collie reports taxable income of $400,000 for the current year, how much of the Border NOL can be utilized in the current year? And how much of the Border NOL may Collie utilize in next year if its taxable income remains the same? Assume a 365-day year. Okay, so Border's NOL is $500,000, Collie's taxable income $400,000 for this particular year, which is not a leap year. Border shareholders moved from 100% ownership to 70% ownership. Border is the one with the NOL. Their shareholders moved from 100 to 70. That is not a 50% change. It's a 30% change. So Section 382 is not triggered. Days remaining after September 2nd, 28 for September, 31 for October, 30 in November, 31 for December. That's 120 days. 400,000 times 120 over 365. Why they very carefully said September 2nd, I don't know, because that doesn't come out at all even. It's 131,507. So you can use 131,507 of the NOL carryover in the current year. They gave us the long-term federal tax rate and all the other information we needed, but we don't use it because 382 is not triggered by this 30% change in ownership percentage for the Border shareholders. So we can use 131,507 in the current year, and then what's left, 368,493, is available without restriction in later years. As much as you can use, you can use. Problem 45. Zeta Corporation is interested in acquiring Tau Corporation in a Type A reorganization on January 2nd of the current year. Zeta stock is valued at $50 million, generates $5 million of taxable income yearly. Tau is valued at $7 million and holds a $1,470,000 NOL with 9 years remaining of the carryover period. So this is old tax law where the carryovers on NOLs expired. Any carryover from that previous period, the expiration date still applies. So there's 9 years left. Eventually that'll all run out and you won't have to worry about expiring NOLs anymore. But they're still with us for a few more years. If Zeta earns 7% after-tax rate of return and the federal long-term tax exempt rate is 3%, what value should Zeta place on Tau's NOL? Then it says construct a spreadsheet, Microsoft Excel. They keep telling us to use Microsoft Excel. We'll use Microsoft PowerPoint once again instead of Excel. And the combined marginal state and federal tax rate is 25%. So we're going to get to use that NOL for state tax purposes as well as federal. Apparently the state tax rate is 4% because we know the federal is 21%. So the Section 382 limit, 7 million times 3% is 210,000. That's all that we're going to be able to deduct because this definitely is a triggering event. Zeta stock valued at 50 million, Tau stock valued at 7 million. So the Tau shareholders are going from 100% ownership to some very small number, way under 50%. They didn't tell us exactly how much of a percentage, but based on the values, clearly it's going to be a more than 50% drop. So 382 is triggered, and we cannot deduct NOLs of more than 210,000 per year. 1,470,000 divided by 210 is exactly 7. So it'll take 7 years to use up that 1,470,000. There's 9 years left to go. We can do it in 7, so we're good. We can get the whole 1,470,000, but we're going to have to do it at the rate of $210,000 per year. Zeta is throwing off $5 million of taxable income. So if 382 was not triggered, we could use the whole thing in 1 year. Basically, we would have no trouble using it in the first year. Even though we don't have exactly 100%, we got almost 100% of the year because the reorganization happened on January 2nd. But anyway, we can't. We can only use 210, and so therefore it's going to take us 7 years. The tax benefit of that NOL carryover, federal and state, 210,000 times 25% is 52.5. So what you've got now is a 7-year annuity of 52,500. And they said that Zeta is earning 7% after-tax rate of return. The 7% discount rate, 7-year annuity, the annuity factor is 5.3893. You actually find the annuity factors at the end of the textbook. They've got the present value tables there. So the present value of a 7-year annuity of 52,500 at 7% a year, 52.5 times 5.3893 is 282,938. So that's how much value Zeta should place on the NOL. And of course, what they pay for the entire corporation depends on the value of the NOL, as well as the value of all the other things that they're buying. And they add it all up, and hopefully they decide they got what they paid for. But this is what it's worth to them to get that NOL, 282,938. Earnings and profits. This is a much simpler issue than the one with the net operating losses with their Section 382 triggers and all the rest of it. Earnings and profits of the transferor are added to the earnings and profits of a successor corporation. So if they're both positive, just add them up. If they're both deficits, add them up, and then you've got that much of a deficit. The only issue that arises, you cannot use a transferor's deficit earnings and profits to offset the successor's pre-transfer positive earnings and profits. And vice versa. You can't use the successor's deficit earnings and profits to offset the transferor's pre-transfer positive E&P. So if one's negative and the other's positive, you can't offset them. So what do? Well, you have to maintain two E&P balances, one plus and one minus. Now what do? Well, apply any undistributed positive current E&P to the deficit balance. So obviously what you're going to distribute, first of all, comes out of current E&P. If you didn't distribute all the current E&P, then what's left over, that positive number goes to the deficit balance. If you have negative current E&P, or if you make distributions in excess of current E&P, well, then you're going to apply that to accumulated E&P. That's going to go to the positive balance. Okay, so you've got negative accumulated E&P and positive accumulated E&P. Anything that affects accumulated E&P, if it's positive, go to the deficit balance. If it's negative, go to the positive balance. So in both cases, you are moving towards zero. You can essentially think of the two as racing toward the finish line of zero. Whichever one gets there first is now zero, and you can ignore it. And then you continue on with your remaining E&P balance, which is either positive or negative, whichever one didn't get to zero. And that just becomes your one E&P balance at that point. So it's pretty easy. You just have, if you have a positive adjustment to accumulated E&P, put it to the deficit balance. If you have a negative adjustment to accumulated E&P, put it to the positive balance. Eventually, one of them will zero out, and then you've just got the one balance remaining. And that's it for the corporate attributes and what to do with corporate attributes when you have a reorganization, such as we've seen in Chapter 7. That's it for Chapter 7. We'll begin Chapter 8 next